Here's something almost nobody talks about. Many entrepreneurs are paying way more in taxes than they legally have to because you've been sold a lie about how taxes actually work. The lie is this: you do your thing all year, you make money, you hand your numbers to your CPA in March, they file your taxes in April, and that's that. That's not tax planning, that is tax filing. And the difference between those two things, the difference between being reactive and being proactive, could easily be worth $10,000, $20,000, even $40,000 or more per year to your business. So in this video, I'm going to show you exactly what tax planning is, why most entrepreneurs aren't doing it, and the specific strategies you should be implementing right now, regardless of where you are in your business. So let's get into it. Okay, so before I get into the actual strategies, I need to shift something in the way that you think about taxes. Because if you don't get this part right, the rest of this video won't matter at all. And here's the belief that most business owners are operating from: taxes are something that happens to me at the end of the year. Now, you work all year, you sell products, money comes in, and then in March or April, you hand your numbers to your CPA or your accountant, and they tell you what you owe. You write a check, you probably cry a little bit, and then you move on. That's the system that most people are using. And the system is costing them a fortune. Because here's the thing: I'm not saying that your CPA is bad at their job. A lot of them are excellent at what they do. But here's the problem: filing your taxes and planning your taxes are two completely different things. And most CPAs, especially the ones who aren't specialized in e-commerce, are doing the first thing, not the second. Because tax filing is reactive. It's looking backward. It's taking the year that has already happened, organizing the numbers that have already happened, and reporting them to the IRS. And at that point, the game is over. Whatever decisions that you made throughout the year, how you structured your business, what you bought, when you bought it, how you paid yourself, all of that is locked in. And tax planning, on the other hand, is proactive. It's looking forward and it's making strategic decisions throughout the year specifically to reduce what you're legally required to pay. A key word there is legally, because we're not talking about hiding income. We're not talking about shady tactics. We're talking about understanding the tax code and using it the way it was designed to be used. Because here's something most people don't realize: the tax code isn't just a list of rules telling you how much to pay. It's also full of incentives, deductions, credits, strategies, those things that the IRS and Congress have built in specifically to reward certain business behaviors. The sellers who understand this don't think of taxes as something that happens to them. They think of taxes as a system they can work with. Now, that mindset shift is the foundation of everything else. And if you're realizing you may need to start looking into how to best do tax planning, reach out to our team at EcomBalance. We specialize in bookkeeping, tax planning, and income tax filing for e-commerce businesses. And the link is in the description for you. Now, in a minute, I'm going to show you the specific strategies that make the biggest difference for e-commerce sellers. But first, you need to see the actual cost of not doing this, because I think when you see these numbers, it's going to make this a lot more urgent. So let me show you an example of something that happens more often than you'd realize. There was a seller doing $3 million in annual revenue who was working with a generic accountant, not an e-commerce specialist. When an e-commerce CPA reviewed their situation, they found that this seller had overpaid the IRS by $44,000 in a single year. Not because they were hiding income, not because they were doing anything wrong, but because of one specific mistake. Their accountant had reported the full amount on their 1099-K from Amazon as taxable income without accounting for the sales tax that Amazon had collected and remitted on their behalf. And so here's what I mean by that. When you get your 1090-K from Amazon at the beginning of the year for last year's numbers, that number includes everything: your actual product sales and the sales tax that Amazon collected from customers and paid to individual states on your behalf. That sales tax is not your income. You never touched that money. Amazon collected it and sent it directly to the state governments on your behalf. But if your accountant doesn't know how Amazon's systems work, and most generic accountants don't, they can easily report that full 1099-K number as your taxable income. On $3 million in revenue, that mistake alone was worth $44,000. Now, you might be thinking, okay, but I'm not doing $3 million in revenue. Fair enough. Let me show you what this looks like at smaller scales. So if you're doing $300,000 in revenue, that same type of mistake could mean that you're overpaying by $4,000 to $5,000 in a single year. These aren't life-changing numbers on their own, but here's what makes that painful. This happens every single year after year after year, quietly draining money out of your business that you legally do not owe. And that's just one mistake. That's not even getting into the proactive planning strategies that could reduce your bill even further. So let's talk about what tax planning actually looks like in practice. Because I want to walk you through three shifts in how you think about taxes. Because these three shifts are what separates sellers who are overpaying every year from sellers who are legally paying significantly less. Belief shift number one: stop thinking your CPA handles this. Your CPA handles tax filing. Tax planning is a collaboration. You need to be having conversations with your tax professional throughout the year, not just in March when they're asking for your documents. The decisions that affect your tax bill are made in January, April, August, October, throughout the year. They're made when you decide how to structure your business, when you make major equipment purchases, when you decide how to pay yourself, when you decide how much to invest back into inventory. By the time your CPA is filling out your tax return, the opportunity to change those numbers has already passed. Belief shift number two: your business structure matters more than you think. A lot of entrepreneurs start as sole proprietors or single member LLCs, and that can be fine when you're getting started. But as your revenue grows, the way your business is structured has a massive impact on your tax bill. For example, operating as an S Corp instead of a sole proprietor can, in the right circumstances, reduce your self employment tax exposure significantly. Self employment tax is 15.3% on top of your income tax as of the time of me recording this video. That's not a small number. And here's the thing: you can't just switch structures in December and expect it to help your current year taxes. These decisions have to be made proactively at the right time with the right professional guidance in the right scenarios. And so for some of you, an S Corp may make sense, and for others, it may not. But that's part of tax planning, is having somebody that understands all of the different details. Belief shift number three: deductions aren't just an afterthought. Most sellers think about deductions at tax time. They may think, let me gather all my receipts and see what I can deduct. That's backwards. The business owners who pay the least in taxes are thinking about deductions throughout the year. They're asking, is there a business reason I could make this purchase before the end of the year? They're tracking every expense category consistently. They're not scrambling in February to remember what they bought last year. And when you shift from reactive to proactive on your deductions, you start finding things you'd never catch otherwise. Now, I want to get into the specific deduction categories that e-commerce sellers most commonly miss, because these aren't complicated. You don't need a law degree to understand them. You just need to know where to look. But before that, here's where it gets tricky for Amazon sellers specifically. Your revenue probably isn't consistent month to month. And this is the case in all e-commerce businesses, really, because Q4 might be your biggest quarter by far. And many e-commerce businesses have seasons of large seasonal differences, right? Maybe you are a brand that operates much better and higher revenues in the summer, whereas some brands operate higher revenues just in the fourth quarter. You might make more in October, November, and December than you do in the other 9 months combined. The IRS doesn't care about seasonality. So what happens to a lot of sellers? They have a great Q4, revenue skyrockets, their profit skyrockets, but because they weren't tracking their numbers closely throughout the year, they didn't adjust their projected tax payments to reflect what Q4 was going to look like. And then in April, they get a tax bill plus penalties that they weren't expecting. So the fix is straightforward. You need to be looking at your actual profitability regularly and adjusting your estimated tax payments accordingly. That requires clean books that are maintained monthly, not just updated once a year at tax time. This is why bookkeeping and tax planning are not two separate conversations. They're the same conversation. If your books aren't clean and current, you cannot plan your taxes properly, period. This is something we deal with constantly at EcomBalance. Sellers come to us after getting hit with a surprise tax bill that they weren't expecting. And when we dig into the situation, the root cause is almost always the same. Their books weren't being maintained regularly, so nobody had visibility into what was actually happening with their profitability throughout the year. When you have clean, current books maintained by a team that understands e-commerce, that understands FBA fee structures and multi-channel reconciliation and how to properly account for inventory, you can actually see your profitability in real time. And that means you can make proactive tax decisions instead of reactive ones. Now, if you want to talk to our team about what this looks like for your specific business, there's a link in the description to book a call with our bookkeeping and tax specialists. There's no pressure, it's just a conversation. But regardless of who you work with, please get someone who understands e-commerce specifically. A generic bookkeeper or CPA who doesn't understand how Amazon settlements work, how FBA fees are structured, how to reconcile across multiple channels with Shopify and Walmart and TikTok Shop and more, they're going to miss some things that cost you money. Now, here's the thing I really want you to understand, and this is the part that most sellers never hear. Tax planning isn't about finding some secret loophole. It's not about complicated structures or schemes. It's about building simple, consistent systems that capture the deductions and strategies you're already entitled to, and then staying proactive throughout the year instead of scrambling in April when it's too late. The sellers who handle taxes really well aren't doing anything exotic. What they're doing is first, they have clean books maintained monthly by someone who understands e commerce. So when it's time to make a tax decision, they have accurate data to work with. Two, they have regular conversations with their tax professional each year, not just at tax time. And three, they're tracking their expenses consistently throughout the year, not scrambling to find receipts in March. That's it. That's the entire system. It's not complicated, but it does require some intentionality. It requires treating your tax situation like a business system rather than an annual event. And here's what that looks like on the other side. When you have clean books, when you're working with an e commerce specialist, when you're planning proactively, you stop dreading tax season. You already know roughly what your bill is going to be because you've been watching it throughout the year. You've already made the decisions that reduce it as much as legally possible. And you go from reactive to in control. And for a lot of sellers, that's worth more than just the money saved. It's the peace of mind that comes from actually understanding your financial position. Here's what I want you to take away from this video. One, tax planning and tax filing are not the same thing. Filing is reactive, planning is proactive, and the difference between the two is real money. Two, the most common mistakes, like reporting your full 1099K as income without adjusting for sales tax, are costing Amazon sellers thousands of dollars per year that they legally don't owe. Three, the most important deductions you're probably missing aren't exotic. They're your cost of goods sold tracked properly, your home office expenses, your tools and software, your vehicle mileage and equipment. Start tracking these consistently. Four, none of this works without clean, current books. Financial clarity is the foundation that makes everything else possible. And so here's what I want you to do right now. First, if this video helped you understand something that you didn't before, be sure to hit that subscribe button. We post content regularly on how you can best build in systems for your finances to be able to manage your bookkeeping, your taxes, and your numbers more properly across your entire e-commerce business. This is just one piece of a much bigger picture on this channel, and so be sure to check out some of our other videos as well. Now, second, go into Seller Central right now, pull up your 1099K from last year, look at that number, and then ask your CPA or your tax professional, is this number adjusted for sales tax that Amazon collected on my behalf? If they look at you confused, that's a major signal that you need to speak with somebody else. Now, third, if you want to talk to a team that specializes in e-commerce bookkeeping and income tax planning for Amazon sellers specifically, book a call with us at EcomBalance. The link is in the description, and you can check it out at bit.ly/ecombalance consult. We'll take a look at your situation, and we'll tell you honestly whether we can help and by how much. You work hard for every dollar your business makes, so be sure not to give more of it to the IRS than you legally have to. I'll see you in the next one.